Here's something nobody tells you before you turn 18. The credit card you pick first can quietly follow you for the next 10 years. Not because of debt, not because of interest, but because of something called credit history length. And once you understand it, you'll never look at a beginner credit card the same way again. Most people walk into their first credit card decision backwards. They chase the card with the flashiest cashback percentage or the coolest metal design. But here's the truth. Your first card isn't about rewards. It's about becoming visible. Without any credit history, banks, landlords, and lenders literally cannot evaluate you. You're what the industry calls credit invisible. And credit invisible people get rejected for apartments, denied car loans, and pay higher insurance premiums. All because there's no data proving they're responsible with money. So how do you become visible? You need one thing above everything else, a card that reports to all 3 credit bureaus, Experian, Equifax, and TransUnion, every single month. That's the entire game in the beginning. Now here's where it gets interesting. There are really 2 paths depending on where you're starting. If you have 0 credit history, no score at all, secured cards are your gateway. You put down a deposit, usually $200, and that becomes your credit limit. It sounds restrictive, but it's actually the safest way to prove yourself to a bank without them taking on any risk. The Discover It secured card became a favorite because it does something most secured cards don't. It still gives you rewards while you rebuild, and it hands you free access to your FICO score so you can watch your progress in real time. If you're a student or you've got a thin credit file, you might not need a deposit at all. Cards like the Chase Freedom Rise and Discover It Student Chrome were built specifically for people with no score, no deposit required, and a flat cashback rate on everything you spend. That's a meaningful difference. One path asks you to put money down. The other simply asks you to prove you're trustworthy through your spending pattern. But here's the psychological trap almost every beginner falls into. The moment they get approved, they treat their limit like found money. A $500 limit starts to feel like $500 to spend. It's not. It's a tool to demonstrate one number, your credit utilization. This is the second biggest factor in your score, right behind payment history, and the rule is simple. Never let your balance climb above 30% of your limit. On a $500 card, that means never carrying more than $150 at any given time. Payment history alone makes up 35% of your entire score. One missed payment can undo months of progress. That's why the smartest beginners automate everything. AutoPay isn't a convenience feature. It's a credit score insurance policy. Now, once you've built 3 to 6 months of on-time payments, something shifts. Issuers start reviewing your account automatically for a credit line increase, which lowers your utilization without you spending less. This is also when a lot of secured cardholders graduate into unsecured cards and get their deposit back. Here's the part almost nobody explains. You should keep that very first card open for years, even after you upgrade to something better. Why? Because average account age matters. Closing your oldest card shortens your credit history overnight and can quietly drop your score, even if you never missed a single payment. So if you're choosing your first card right now, ignore the flashy sign-up bonuses and the shiny metal cards your favorite influencer is holding. Ask 3 questions only. Does it report to all 3 bureaus? Does it charge 0 annual fee? And does it offer a real path to something better? Get those 3 right, and your first credit card stops being a purchasing tool. It becomes the foundation of your entire financial future.